That takes us to China. I mean, you were one of the first to point out the major problems in China. You know, you did your rather amazing video wandering around empty housing estates, etc., etc., which I think was pretty well watched. What's your view now?
I think my view would surprise you. Before I surprise you, I would like to seek legitimacy with the view by telling you that I have made money. It's been my most successful profit centre in the year to date. And we've made over 5% trading in China-related macro themes. In terms of surprising you, I am more sanguine about China. And actually I've been rather impressed by their policy responses over the last 2 years. When I look at China, China has got two components. It's got this manic investment, gross capital formation, and something which is has been deepening these global deflationary fears because they kept expanding over capacity industries such as cement and steel and undermining prices in the rest of the world. That in itself, if you will, lowers these inflation figures below central bank targets. It becomes reflexive, and then the central bank says, crikey, I've got to be radical here, I've got to buy equities. So there's been that going on. On the other hand, there's been a kind of robbing Peter to pay Paul, and that China's had a decade which has been very, very similar to that of the US in the 1920s. The US, people forget this, but you know, Liaqad Ahmed, I've just destroyed his name, forgive me, but the Lords of Finance author.
Yeah. I
reread it recently, and I was very taken by the notion of how mean the Fed had been in the 1920s. Again, I said to you with cathartic crisis, the response for the rest of the world is to be long dollars invested in America, and that was certainly the case in the 1920s. But America was recovering nicely from the Great War, and it had this incredible productivity revolution, and there was great demand for credit, and so it was fine on its own. But the rules of the gold standard meant that as Europe kind of pushed all of this easy credit to America via the manifestation of these gold balances, the US growth should have been even more intense, that the Federal Reserve kind of had a moral obligation as part of the game of the gold standard to let loose that gold into the economy via bank lending. And it didn't. It was very, very hard money doctrinario, and it withdrew that gold and it buried it deep in the vaults. And it's never really been reflected upon because we just know that America boomed. The argument is it should have boomed even more, and if it had done so with even greater ferocity, and this is counterfactual, so Niall Ferguson will kill me, but
it's all right, he's not here.
But if it had, then perhaps it could have resuscitated, especially poor old England or Britain, which had gone on the gold standard in 1925 at a desperately poor moment. It would have given it the rationale that you went on for the rules, and the other guy, the big guy, didn't play the rule, and you got squashed. So counterfactual, and I think it would have created more price inflation, and so US rates would have spent a decade on the floor, and asset prices, they would still have bubbled, but I think the bubble would have been earlier and could have been dealt with. Counterfactual.
Okay, well, we'll never know about that.
We'll never
How
know
does
that
connect to China?
So the meanness, China's had a very similar decade where such with a huge returns on investment on offer because land prices are low, labour's low, you can borrow money, the currency's cheap. So you wanted to manufacture, you want to have business in China. And so the rest of the world, en masse, you had, if you will, it's like that gold transfer from the 20s, this time is via fiat money and institutional portfolio allocations into China. So China should have boomed. Yes, it did. It boomed, okay? But it should have boomed even more. Rather than growing at 10%, it should have been 20%. I'm making these figures up. The reason it didn't was that they, as I said, they robbed Peter to pay Paul, and they took the great bounty of the productivity leap that their household sector, their workers were achieving. They got paid more, but they should have got paid way more. And their currency appreciated, but it should have appreciated way more. And they got negative interest rates when they put, you know, this hard-earned capital back into the system. So they got screwed, if you will, on three fronts. And as a result, consumption declined. It didn't decline because they were just more cautious and these kind of incredible Asians that just want to save. No, nonsense. Their income got constrained versus its capability. So consumption, incredibly low as a percentage of GDP, and this manic deflationary capex boom, very high. Mm-hmm. And the last 2 years, it looks as if they've sought to challenge that. You know, the bullish take on China is this 35% of GDP. Through proper husbandry, that could continue to expand 10% per annum. And that underwrites a 4% floor to the Chinese economy, clearly, if you do the maths. So how would you do that? Well, you would take away these negative interest rates. Mm-hmm. They've done that. Either in the misfortunate means of the higher risk from these wealth management products, but with these internet platforms offering money market rates. Yeah. Okay, so there's a movement. The currency has appreciated, much to the chagrin of those at the beginning of the year said, "Oh, it's going to devalue," and they're going to tell you that it's going to devalue. On the currency, again, valuations, fugazi. When I look at it, I see an economy where the urban population is fully employed. I don't see an inflation problem. It seems to be able to compete in the world, and it's finely balanced. So I'm not sure, is the currency overvalued, undervalued? It's kind of close to fair value. Yeah. We're long the currency, actually. And lastly, just on that, but the wages, and wages have grown at a tear. Yeah. So the consumer is enjoying a dramatic relative improvement in its lot. Okay, and I think that's one argument that doesn't get a mention. So the notion of a Chinese devaluation would be exactly the wrong policy, because of course you would then be killing the household sector again. The goose that could lay the golden egg has to be cherished, and it needs a rising currency, I would argue.
But you're assuming that the correct policy will be followed?
Well, it has been to date, that they haven't panicked and gone into that crazy splurge in 2009, 2011. They haven't done that. And then the other point with China is, so it's a bit like the US. It's had its excess. The problem in the US was it was felt intently with the private banking system, which went bankrupt. But, and this is not counterfactual, what if what if the state is the banking sector? Does it have a Minsky moment? I would say it doesn't. So the whole game with Fed QE was to underwrite the collateral values to keep the credit system moving. So it aimed its fire at mortgage obligations more than treasuries. The whole deal with LTROs in Europe has been, again, to when investors are valuing banks at 40-60% discounts to asset value, the central bank's coming and saying, actually, we'll buy it from you at full value or something higher. So we are going to endorse the collateral of your assets. And in China, it's the same deal. They're a fiat currency, and they can kind of get away with this. And they are. So it's like to bet against China or Chinese equities or the Chinese currency is to bet against the omnipotence of central banks. One day that will be the right trade. I'm just not ready or sure that is the right trade today.
Okay, so yes, what are your China trades now? You said there were 3 different.
This is a technical trade, but we have been paying interest rates in the offshore market. So interest rates, the Chinese currency for many, many years has appreciated at an incredibly unvolatile manner. And so you've been able to borrow money very, very cheaply by going along the CNH. And then through surreptitious means such as the over-collateralizing of bills of credit or using commodities, but through guile, if you can take that cheap money and get it onshore, then you can invest in a wealth management product from the guy down the street at 15%. So it costs you, your cost of capital is 1, it's 15. When you go to pay it back in a year's time, your liability's been diminished because it was the biggest carry trade of all time.
Yeah.
And our argument was, China still has this insatiable desire and indeed requirement for capital. It needs money. And so it made sense as we looked at it at the beginning of the year. They had to form a legitimate bridge to tap this cheap money that was residing offshore and bring it through a legitimate manner onshore. And if it could do so via, and the latest incarnation of that would be this connect scheme between the Shanghai and the Hong Kong markets. But they've also developed enterprise zones where you can do that free exchange from the offshore to the onshore, and a host of other developments. And the net result of that is that you would get a rates convergence. But the great macro trade of the of 15, 20 years ago was the European rates convergence. They were very high in the periphery and they'd come down to the centre. And there was a notion that these very low rates in China offshore would come up to the levels that prevail domestically. That's pretty much come to pass, and we've made money from that trade. But why we've especially liked it is that because you're paying rates, if I'm wrong with my kind of sanguine take on where China is today, and there truly is a liquidity crisis, a banking crisis, what do you get? You get these SHIBOR, these intermarket rates, they shoot up, you know, and the liquidity gets withdrawn from the offshore market, and I'm paying those rates, so if they go up, I make a lot of money.
So as a trader, it works either way?
Either way, which is really, if we started this conversation, define what makes it either macro or a good macro, it's finding trades of that nature.
Okay, and other trades in China?
I guess the other prominent trade, well, we have the currency.
The currency,
and so the currency, I mean, we are in the grips of evaluating whether we are moving on to this a new bull market for dollars, and clearly the sensitivities as we've discussed on the renminbi. We're long the renminbi via options, and again because the vol is so low, I can get a big exposure. But should it be that the dollar begins to appreciate versus the renminbi, we can turn that into a vol trade, and vol is very low. And so if you were to get an event, and I don't think you'll get an event, but if China was to have the misfortune of Korea or Thailand, etc., in the late 1990s, and you had like a 40-50% devaluation, the volatility would go from like 2.5% to 82. Right? You would just make a fortune. So we don't. We can tailor. So we have that. We don't think that's going to happen, and we think the most likely path is the currency appreciates. But we can rapidly adjust it if that view changes, and suddenly it's this huge vol, and we're protected.
So another trade that works both ways, really.
Yeah, and then the last trade, which it works only one way, is that if we are correct in our notion that the terms of trade are dramatically improving for the Chinese household sector, then how do you what's your closest proximity to the household spending bonanza in China? And it's the internet giants. So we're along the Baidus and the Tencents of this world. We just think, and again, valuations are high, but growth rates are high.
It's another area where you don't care about the valuations at the moment?
Not at this moment, no.
Okay. Tell me what your favourite of all those trades are. Not just the Chinese one, everyone. Come on, everyone has a most loved trade, a most loved market.
No, I don't. That's a hard question.
Okay, when we turn around, what would make you saddest if it failed?
I deal with failure all the time. Failure is part and parcel. It's moving on from failure. What would make me saddest, and again, is this notion of good hedge funds, is that you never fear the consequences of your risk taking. You don't fear the consequences of being wrong, and such is the way we put our book together. That's the space I am. So I struggle to answer the question because, a failure for me is not being contagious, is not being actively engaged, because if you can put it together properly in your portfolio, who cares if you're wrong? It's boring, move on to the next. There's always another trade.
There's always another trade. Thank you, Hugh.
Thank you very much.